Yo, what's going on, everyone? Welcome back to another video. In today's video, I'm going over this thing called the Sunday, Monday, Tuesday strategy. It's a pretty stupid name, but you can call it whatever you want. But yeah, basically this strategy. Okay, actually, before I get into the strategy, I just want to make a quick statement. I want to apologize for not posting so much lately. No excuses, just life has been extremely busy lately, and there's a lot of stuff going on over here. But it is the summertime now, so I'm free and expect a lot more videos coming out from me. A lot of banger, high quality videos. So let's get straight into this. So let's just call it the weekend strategy. What is this weekend strategy and how do you use it? It's really simple and it's not hard at all. Now, in order to understand the strategy, what we're going to have to go back to is the basics and fundamentals of market structure. Right, I'll give a quick rundown over market structure, but if you don't have a good idea on how to trade market structure and what a higher high is or what a higher low is, then watch my other videos. A pop-up should come on the top right on the screen right now, so click on that link and you can get a good idea and then come back and finish the rest of this video. So what is market structure? Market structure is basically the thing that we look at Forex to get an idea of what's happening in the market, right? Like, for example, if we look at all these candles, right, and we don't know what market structure is, we're not going to have an idea of what's going on. But when we have information and we know what market structure is, we can actually understand every single move that's happening in the market. For example, right over here, when we see this impulsive move up and then we see this random move down and the market starts going down, does that mean structure is bearish? No, all it means is for the time being, momentum is going to be bearish, but the market structure will remain bullish until we break past this low. So that's an idea of how market structure works. Now, to give a quick rundown over market structure, it'll be really simple and I'll go over this really quickly. So we have a low in an uptrend, we have a low, we have a high, and then there's going to be higher highs and higher lows in an uptrend. What this basically means is the market is going to consecutively print higher highs that are higher than the previous high, as in right over here, and we're going to create higher lows which are higher than the previous lows. So for example, you have one low here and then we create another low which is higher than the previous low, and then we create another low which is higher than that previous low. So now that and then it's the vice versa with a downtrend, right? The market will create lower lows, lower highs, and every low is going to be lower than the previous low, and every lower high is going to be lower than the previous lower high. So now that we got a good understanding of what market structure is, how are we actually using this in the strategy, and when does it take place? As in, like, when are you using market structure? So the key to understanding this strategy is going to be to look at how the market closes and how the market opens. And I'm going to explain this. After backtesting for several weeks, I've realized that the market makers are going to plan out their next move right before the market closes last trading week. So for example, on Friday, right, when the market closes on Friday, you might see that right on Friday, there is a final break of structure and then the market closes at its impulse point right over here. And then this is Friday and the market closes. And then obviously there's that gap on Saturday, Sunday where there's no trading happening. And then next week the market opens. So then I started to question myself, how come the market does a break of structure on Friday? Why can't we wait until Monday or Sunday and then the market does it? Well, the reason it's doing that is because on Friday they already have their plan. Think of them doing their homework early. They already have their plan on where they want to take price action next, and then they're saving Sunday and Monday to fill in those orders. That way Sunday and Monday all they have to do is fill in the orders and the market can go up. So they're basically minimizing one step. They're taking one step away by doing it on Friday, right? And now what the reason this is extremely important is because we were told as traders that you never want to trade on Sunday and Monday. Why? Because, you know, apparently there's low volatility and there's not a lot of volume, and the market goes for liquidity around Sunday and Monday. Now, I used to follow this concept as well. I would not trade on Sundays and Mondays. I generally used to believe that Sundays and Mondays were days for banks where they would take liquidity. But what I started to realize is Friday, Sunday, and Monday, these are the best time to get in opportunities. Have you know? I'll print out an example in your head. Have you ever come to the charts? You see a really nice setup, right? You see a clean setup, and then you set your limit at that institutional candle right here at this demand. The market just does not come. It might come near it, but then it reverses all the way to the top, hitting your take profit without you being in the trade. Why does this happen? Well, the reason this happens is because, number one, we know that institutions, they're not going to wait for you to get in the market. We're not important to them. Besides our liquidity, they couldn't care less. All they need is our liquidity, and that's it. Now, they already captured all the liquidity on Sunday and Friday. Why? Because while every single person was looking to sell on Friday, while they were following this bearish momentum, what happens is all that supply, all that lower high gets taken out and it turns into liquidity, right? So all this money, all these institutions and retailers who are holding trades overnight from this downtrend, the market opens on a Sunday and takes out all that money, or it could happen on a Friday as well. The market takes out all that money and then it makes one final retracement. Now, this retracement may happen either during Sunday or Monday. It's going to be one of these 2 days, and Tuesdays, Wednesdays is going to be the day where the market just fully expands. Now, remind you, this doesn't work all the time. Obviously, this is something that works sometimes, and you just have to keep an eye out for this type of specific setup. But like I said, after all that money gets taken out, the market is going to come back down to find the original expansion move with a demand zone. So let's say this is our demand. And it's going to pick up all those orders and then it's going to go up. It's not going to come back down to give you a couple more entries, consolidate. No, because Sunday and Monday is where the market is. It's basically in a hurry. Think of the market to be in an extreme rush to just go towards their next objective. That way, no one gets in the market. Think about this. 90% of institutional traders such as ourselves, they're retail traders that trade the institutional concept. We're not trading Sundays and Mondays. Why? Because we're told not to. From a retailer, we were taught this as retailers to never trade Sunday and Monday, and we brought this concept into institutional trading, which just doesn't work at all. Now, to show you that this concept works, let me show you guys a couple examples of how I use this to catch a trade on GJ. And yeah, let's get straight into this. So fast forward back to Thursday. Let's delete everything right here. Boom. So we could see that the market is in a clear bearish conditional trend. Market is going down. There's no opportunities to buy as of now. Play a couple more candles, and then you see that on Friday we have this impulsive move towards the upside. Actually, on Thursday we have this impulsive move towards the upside, and then Friday we generally start to go in that counter trend trade. So basically, Thursday you have this impulsive move. Not only do you have an impulsive move, but that impulsive move broke structure. Now, what's the first thing you should be doing after a break of structure is present? After the break of structure is present and you see that impulsive move, your idea should be your mindset should be that every single supply zone that was present before is no longer valid. So if there was a supply zone over here, it's no longer valid because structure itself is not bullish. It's not bearish, sorry, it's bullish now. So if structure is bearish and we've invalidated supply, let's go down to the 1 minute time frame and let's zoom into what's actually going on over here. From an institutional perspective, we can see that there's a break of structure, and then there's people looking to sell this. And then there's people that are literally just following the supply. They're constantly setting limits and just basically following this downtrend. And it's successful. We all know that this is successful and it works. It continuously works. Price action comes into the next supply zone, mitigates it right over here, and then it goes down again. And basically what's happening are these lower time frame traders, they're creating liquidity. Now you might wonder, how is supply creating liquidity? Because we're in a supply zone, right? Remember, after the market breaks structure right over here, or before we even get into that major break of structure over here, let's take a look at the smaller time frame. Once we've seen that there's a smaller time frame micro break of structure, your first initial thought process should be, what is going to happen to my supply zone? All these supply zones that were once maintained and held, what is going to happen to it? Now the answer is these supply zones are basically going to turn into liquidity. Why? How come supply is turning into liquidity? Well, because structure is no longer bearish. In order for something to work, in order for the market to go one specific way, basically flow in a direction, both micro and macro structure needs to be bullish. In this case, if we check the 1 hour time frame, we can see that macro structure on the 1 hour was definitely bearish. If we go to the 1 minute time frame, structure right over here switched. You have that final micro break of structure, and then the market switches and it goes in a bullish direction. So therefore, once you've seen that happen, once you've seen that micro structure is broken and we're no longer looking to sell, and that the market may be in a buy side conditional market now, every single supply zone that was once valid is now invalid, because demand has overtaken supply and supply does not have the momentum to actually overtake demand. So what would happen to a supply zone like this? Well, to a supply zone like this, it would slowly become invalid. That doesn't necessarily mean that there won't be a reaction, because of course it's still a supply zone nonetheless, and you're going to get a reaction. And if we refine this up until this point, it'll look a lot cleaner. But we can see that the market does in fact mitigate it. It gets a one mitigation, a second mitigation, and then an impulsive move down. Now if we look at this from the smaller time frame, we can see that yes, it gave you a break of structure right over here, or a change of character, whatever you want to call it. It gives you that change of character. We grab liquidity, yet the market just did not respect this institutional candle. It didn't. Why didn't it do it? Well, it's because microstructure was broken from this point. So the second you saw that micro BOS, you were no longer looking to buy that, or you're no longer looking to sell. All these supply zones would be invalid. Now making our way back to the 1 hour time frame, we can see that now there's a break of structure on Thursday. Let's see what Friday does. So Friday, what Friday does is it basically enters in that retracement phase. Let me just find Sunday. All right, there we go. So basically Friday, like I said before, it's just going to be in that impulsive stage. Why did the market just impulse? Why didn't it go give you that opportunity on Friday and then go up on Sunday? The reason we did that is because we still have higher time frame traders that are trading the downtrend. What do I mean by that? Well, for example, right over here, we can see there's a 1 hour institutional candle. We can see that there's another 1 hour institutional candle over here. Basically, these higher time frame traders, they're taking sells. They have forgotten that microstructure, and you can even make the argument this is macro / microstructure, is that it's no longer bearish and that we're in a bullish market. So what the market is going to do is it's going to show you that bullish impulsive move up, but to a retail eye, all this really is it's a retracement to come back and retest a previous area that was broken as respected as support. That's going to be retested as resistance. Even a level like this, we can see this is a level that was tested as support, and eventually price is going to come back to retest it as resistance. But this is obviously retail concepts. So where is the market going to go next? Where the market is going to go next, this is where you have to involve discounted and premium fib levels. So measure the last impulsive move down and find the institutional candle that resides at the top. Now in a bearish market, the blue zones, you guys can copy my fib levels right over here. Pause the video, copy it, there you go. Boom, boom, boom. So yeah, as you can see over here, the higher it is, the more premium, and the more premium, the better, the stronger. So in this case, we can see that Thursday we have that break of structure. Friday continues his bullish momentum. What is Sunday going to do? Well, Friday left 2 institutional candles left to mitigate. We left 1, 2. We left 2 areas of demand that the market has to mitigate now. Simple as that. So we're going to mark up this demand zone. And remember, while everyone is telling you do not trade Sundays and Mondays, go to Tuesday, Wednesday, Thursday, Friday, Tuesday, Wednesday, Thursday, you have 3 days to trade. We are going to be getting in on the biggest opportunity throughout the week. Sunday and Monday is going to give you the best trades ever. And I can promise you that. Me personally, I've been trading Sundays and Mondays, and I get the best trades on Sundays and Mondays. So we have Sunday market opens, and no one's really looking at the market at this point. And then, oh, I made a mistake. Sorry. So Sunday the market opens. Before I get to that, let me explain what's happening here. So Sunday the market opens, and as I said before, there's not that many traders that are looking to get involved. Now there might be 50% retailers that are on the 1 minute time frame. They just heard about Forex and they're like, oh my god, there's a resistance. Let me buy now. Resistance turns into support. Oh my god, more resistance. Basically, there's still going to be some traders buying, right? Those retailers, we've all been there before. Those retailers who come to the market after watching the trading channel, learning what support and resistance are, they come to the markets and they have no patience whatsoever. Zero discipline, zero patience, and it's straight instant gratification. And they come to the charts and they start buying and selling, but it doesn't work out. So we know from a higher time frame perspective that the market from the 4H has created this institutional candle, right? And Sunday the market is going to go down to mitigate this. Notice how Sunday the market is going to mitigate it, and then Monday and Tuesday is going to impulse. So let's play this out, and we can see Sunday the market finally mitigates it. We go straight down to the 15-minute time frame to monitor microstructure, and we can see that microstructure is no longer bearish. We have this one a high, a low, a lower high, a lower low, a lower high, and then a lower low, and then the market goes up to break all this lower high, lower low structure, which basically confirms that our demand zone was in fact valid and correct, right? And the reason we wait, I'll give you guys a quick lesson on why it's important to be patient. Imagine if I didn't set a limit. Imagine if I didn't wait for confirmation and I simply set a limit. If you just look at it right now, right? There's literally no reason. There's no confirmation. There's no way I can confirm that this demand zone is going to hold and go up. But after I wait and I see that the market has entered and that it's actually changing structure, the momentum is shifting, right? If we even go down to the 1 minute, we can see the volume in the bulls is completely different than before. We can see that there was obviously a big player getting involved on Monday compared to a big player getting involved on Sunday because the volume was different. So simply just by waiting and being extremely patient can completely change your entire probability and profitability to be in a profitable trade. So it's literally patience and a good trading plan. So we can see that now we have this impulsive move on Monday. We have confirmation to do what? To find our institutional candle that caused that breakout structure. Now, before I do that, let's talk about what happened over here. What happened over here is after price action entered our demand zone, there's still people looking to sell. And this goes for institutional traders as well. Although I did say that there aren't many institutional traders trading, that doesn't mean there aren't any. I just said there aren't many. So we still have institutional traders that are looking to sell. And what do we follow as someone who trades market structure? We follow the concept that the second price action enters our higher time frame demand, every single supply zone is no longer valid. So what's happening right over here is when price action enters this supply and it's actually maintaining it, what the market is actually doing is it's letting supply zones create liquidity for demand. So when demand does reverse, demand has more money and more power and more volatility in moving towards the upside. For example, if let's say there wasn't a supply zone here, it was literally just this, there was no supply zone, nothing, and there's no one selling, then the momentum and volume in this move wouldn't have been as strong. Compared to this, we can see right over here, price action enters, right? But there's literally no supply zones. No one's looking to sell, or there is a couple of supply zones, but they're not obvious, and no one's really looking to sell it. So that means that there's less liquidity. That's why the move up was extremely small. Compare it to this one. After we let the market move around for a little bit, we can see that we created this dynamic resistance, and then we created this dynamic support. And then there's also, like I said before, there's supply over here, which is creating more money at the tops. So when there's more money, the market is more vulnerable to go one way in such a strong, unanimous way with a bunch of volatility. Now that we got that out of the way, what I did from here, this was on the 1 hour, or no, was it on the 45, 30, 15? So on the 15 minute, now that we have market structure going our direction, all you want to do is find that last institutional down candle before the impulsive move up. Simple as that, and then you set your limit. Now in this case, let's see what ends up happening. Let's play this out. Okay, so perfect example of a trade that did not plan out the way I expected it to, but that's fine. We can still go take the 20 minute instead. So if I took the 15 minute, I over refined this down to this institutional candle, you would have missed it. But if you took the 20 minute IC and you took it from this entire IC, this would have been a W trade. Nonetheless, this is just an example of how this actually works. So we could see that Monday, we can see that Thursday, the market changed structure. Friday, the market continued that same structure. We're just basically creating demand zones for the market to come back into on Sunday. And then Sunday, the market opens and it comes down into our Friday demand. The demand zone was created on Friday. And then from there, Sunday, the market just consolidates a bit, picks up some orders, and then we have that final retracement back into this final institutional candle that gave us this extreme impulsive move up. Now let's calculate the RR on this, right? Let's go down to the 1 minute, and if you wanted to wait for extra confirmation, by the way, you could have easily done so. There's nothing wrong with having a triple confirmation. If you waited for extra confirmation, it would have looked something like this. So we could see that after price action enters our 20-minute POI, it's actually pretty big as well, so that's about 44 pips, and no one wants to have a 44 pip stop loss, let's be honest. So let's play this out and let's take a look at microstructure. Micro is clearly bearish. And why is it important to focus on microstructure rather than fully have your focus on macro? So the higher the time frame you go, this is the philosophy I follow. The higher the time frame you go, the lower your RR is going to be. What do I mean by that? Let's say I set a limit at this point. That means my stop loss would have been 80 to 78 pips. And my take profit would have been only, well, my take profit would have been the same, but my RR would be so much drastically decreased compared to if I was on the smaller time frame. But when I go down to the 1 hour time frame, I can see that there's a lot more information. Instead of taking this big 8-hour institutional candle, I can now refine this down to here. After price action enters that IC, however, I can go down to the 5-minute time frame and I can get a better look at and get more information. Basically, what you're doing is the smaller the time frame you go, the more you go down, the more information is present. And the more information is present, the higher the RR is, and the lower your stop loss can become. The lower you risk, basically. Now, we can see price action enters your 20-minute point of interest, and we have this microstructure on the 1 minute that's being followed. And what did I say before? After a supply zone or a demand zone is touched, every single supply zone that we had is no longer valid. So if you're looking to sell here, if you're looking to sell here, it's all liquidity now. There's no point of selling there. In this case, we have that final break of structure confirming that microstructure is now bullish. Once microstructure is bullish, this is the market telling you that your demand zone was in fact correct. Because the only reason structure was able to shift is because we fueled it. Think of supply and demand zone as a gas station. Let's say the market is in a bullish direction, right? It's going up. And then we come back down a bit. Why is it coming back down right now? Well, it's coming back down right now because when you look at a car, right? What do you think of? You don't think of the wheel is pushing the car. You don't think that you accelerating is pushing the car. It's the gas that's fueling the car to move forward. Correct? So in a bullish market, what's making the market go higher and higher and higher? It's the demand. It's the consecutive demand that's being flowed and followed. But sometimes you can see in a bullish market, you can see that we have this pullback phase. Why do we have this pullback phase? Well, it's for 2 to 3 reasons. The first reason is because we create liquidity. That way the market can pick up stop losses and go higher and higher and higher. If there wasn't any liquidity, then the market would just look like this. It would be going one specific way. But because we have these little pullbacks where retailers and traders that are basically trading against the bias, they're creating supply liquidity for us, for the buyers. And that's why when we see stuff like this happen, where we see this break of structure, it's because we let supply take over from this point to this point, so the market can later take all this liquidity and go in that one desired direction in a more prolonged and profound way than compared to if there wasn't any liquidity. Now, the market comes back down. As we can see, we enter the pullback phase. So now we know the first reason. The first reason is simply because we want to create liquidity and take it so then we can go up. The second reason, what's the second reason? The second reason is because we create demand zones, higher time frame demand zones that the market has to mitigate. Now, think of these demand zones as gas stations for demand. Price action leaves a higher time frame demand zone and then it impulses up. It's unmitigated. Price is going to come back down. Supply is going to take over and bring the market all the way back down into a demand zone without realizing they're taking it to a demand zone. And once supply finally enters that demand zone, what's going to happen is all that previous orders that were unmitigated, that were left unmitigated, they get transitioned into current momentum. So basically, the previous demand is fueling current demand. So that way the market can go in a higher direction way quicker. And that's what happened right now. We can see that we have our 20-minute point of interest right here. And this is the gas station. As soon as the market came inside of it, all these orders over here, they got transferred into current price right now. And then the market went up, and what did it do? As a result of that demand that was transferred, we break structure. Simple as that. Now from here, same concept. Get your rectangular zone, find the impulsive move up, and look for your institutional candle that caused that break of structure. In this case, you could have taken this one. Entry would have been just the open 032. And then stop loss would be just the bottom at 952. Perfect. And mind you, look at the day. Look at the day that this is all taking place on. This is taking place on a Monday. The day that everyone says do not trade. Do not trade on a Monday. Now, where's our take profit going to be? Now, this is where you have to watch my previous video, which is called missions and objectives of the market. So missions and objectives of the market, it's basically missions and where the market wants to take price action next, where the market maker is interested in taking price next. So basically, it's just a war of supply, demand, supply, demand, supply, demand. We've entered demand right now, but demand can only go up until so long until it reaches a supply. In this case, the highest supply on the 4-hour rests right over here. Or you could even, is this mitigated? Yes, it is. So we're not going to take that. So we're going to take the one on the 3-hour time frame and say that this is the supply zone the market wants to take price action next to. From the 5-minute time frame, we already have our entry and everything set up. Just put that right here, and then take profit is going to be the next high for 218 pips. Now look at that RR. That's a 27-to-1 on a Monday. So let's play this out. So you get triggered in. This wick gets triggered in. I want to quickly go down to the 1 minute and take a look at something. So look at this. So when price action was over here, right? When we were just over here, we expect the market to be bearish so it can enter our demand zone. We expect that. But what's happening to all that bearish structure when the market is going down? The second it enters our demand zone, what are we expecting? We're expecting all that supply to become liquidity once again. So every single lower high that you're seeing right now, guess what? Liquidity, 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 liquidity. And that's why when we enter as institutional traders, we're not just entering at a X level of support, at an X level of resistance, or an X level of demand, an X level of supply. We're literally entering at the pain point time where institutions are looking to go long at. So for example, if we entered at this point right here, let's say we literally just set a limit on the higher time frame. Think about how much drawdown I'd be going through. I'd be going through this drawdown, and this drawdown. I'd be going up, down, up, down, up, down. And no one wants to be in a trade for that long because we have to manage our time properly. Sometimes we forget that as Forex traders, we still have to manage time. Time and money is a correlation to refinement. What do I mean by that? Well, we can see that in this case, I didn't refine. This is our higher time frame POI. Price action enters, right? We enter. It goes up our direction for about 48 pips, and then it comes all the way back down. Now, I'm holding this trade and drawdown for more than maybe 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So I'm holding this trade and drawdown for about 30 minutes. It's going up 1 minute, and then the next minute it's going down. It's going up the second minute, and then the second minute, the third minute is going down again. And basically what that's doing, it's that testing your psychology. The best way to get over a bad habit, or to get or to not fall a slave to your desires, is to never become vulnerable or never be in a position where they're tested. Now, obviously, you can only do that at a certain level or at a certain extent, because eventually you do get tested. Right over here, when you're not refining and you're basically entering without a limit, you're literally testing yourself. You're putting yourself in a vulnerable situation where psychology is extremely tested. So what we do as institutional traders is we say, no, we're going to wait this out. We're going to wait for price action to go bullish, and then we'll enter. So then we have that break of structure right here, and we know that now the market, we've created a range. We've created a range from this low up until this high, and the market shall not go break below this low, because the second it breaks below this low, we know that we're no longer going to be in a we're no longer going to be trading within this trading range, and most likely bears have taken over. So we've limited the range from this point to this point to this point to this point. We basically created a small little box for price to travel in, and we're just creating a smaller box for price to travel in. We're basically trapping price to the point where it can only go one specific direction. And that's exactly what I did here. First I trapped price in this area, and then I trapped price in this area, and then I trapped price in this area. And think about this: the bigger the area, the more vulnerability and freedom you're giving the market to consolidate in, to move around in. Right over here, we can see that we trap price in such a small box that it has nowhere else to go besides this zone. It cannot break below it. It literally just has to go above it unless sellers take over. So now it should be Tuesday. Let's go to the 1 hour. And there you go. Now it's Tuesday. Now at this point, this is when institutional traders are looking to get in. They start seeing a demand zone over here. They see a demand zone right over here. And then they're thinking, why isn't price action coming back down into my area? Why? Well, it's because Sunday and Monday, the banks did everything they wanted to do. They did everything during Sunday and Monday, and now Tuesday, Wednesday, Thursday, Friday, they're not going to put themselves in a vulnerable situation where every other institutional trader is following their footprints, because they're not dumb. They know we're following their footprints. They know that they're leaving footprints and that we're catching on them. But guess what? On Sunday and Monday, there's literally not a single person looking to trade, because they're told that Sunday and Monday is when liquidity is grabbed. They're told that Sunday and Monday is when the market is so like has little volatility, and that it just doesn't make sense, because I proved. Look at this impulsive move. Look at how quickly the market moved in this direction. Now let's fully play this out and see what happens. And then you can see the market literally exploded into our supply, and then from there whatever happened. But yeah, and that was a, what was that? That was a 27-1. Now what's gonna happen next? Usually Tuesdays, Wednesdays, Thursdays, Friday, the market is either going to continue the original trend that happened around Sunday and Monday, or the market is going to reverse based off of the supply it's approaching. So we could see that we had a supply zone over here. The market slowly broke it, but we still have this area that the market is respecting. Correct? So if we fail to hold this area of supply, then the odds are the market is just going to continue to go up. But if structure is slowly shifting, which it is right now, then we can start taking shorts up until our demand zones that we were looking to buy at before. So for example, right over here and right over here, these would be your objective points for the market to go next. But yeah, that's basically how I trade Sundays and Mondays. If you guys found this video really helpful, please leave a like, comment, and subscribe, and backtest this. Make sure you backtest it. It's really simple. All you do is you go to down. First of all, you want to get this indicator right here. It's called session and days of the week. And then literally just look at how the market closed on Friday. If the market closed like this, the odds are the next week, the next market open, we're going to have an impulsive move. And then watch how the market closes that same week. If it closed like this, then the odds are on Sunday and Monday, the market is going to go down like this. So it's literally the opening and the close of the week is what's going to matter the most. So everything else is the same, you know, breakup structure, retracement, impulsive move, all of that worked, and it's the same. So thank you guys so much for watching once again. Leave a comment, and if you guys have any video ideas that you want to see next or potentially see me go over, then make sure you leave that in the comments as well, because I'm going to be extremely active now. But yeah, peace out, leave a like, comment, subscribe, and I'll see you guys in the next one.